Three big trading ideas on the radar for today, so let's hop straight in. We're going to start here with Netflix, and shout out to Ali, one of our Tier 1 trading members who brought this up to us during the week. We're going to dive a little bit deeper into this stock because there's been a divide on Netflix. We've got a lot of people who are interested in buying, a lot of people who are interested in selling, and well, I'm going to give you a reason for both and also show you how they can both work together. Now, real quick, just to catch you up, Netflix has had a rough year. It has fallen nearly 20% this year and is one of the worst performing stocks in the S&P. With that being said, now the cheaper price is starting to attract some high profile investors, including Bill Ackman. Now, I'm not here to tell you whether fundamentally you should want to buy or sell Netflix. That's something that you can do on your own right. But I would say this. As an investor, as we go through our process of analyzing the markets, IPDE, identify, predict, decide, execute, from an investor's perspective, that initial directional bias is created by the fundamentals. So fundamentally, do I think Netflix is a value or do I think it is something that should be dumped? After I've determined what direction I want to be on the stock, then I turn to the technicals to allow me to see when and where are the best places to get involved. And this is what we're going today. So we'll start with the selling opportunity for you Netflix bears out there. Netflix has given us a big head and shoulders top, right? We've had a rally up here from 2023 all the way to this high right here, a little brief retracement followed by a shorter extension to the upside. And then after that, we've had a pretty significant dip right down here, breaking our previous level of structure. An attempted rebound that failed and a move back lower, which is where we are today. This pattern is called a head and shoulders pattern. It is a classic reversal pattern in the market. And what you're looking for validation of the head and shoulders pattern is one of two things. Either for price action to break and close below the horizontal neckline, which would be this purple line right here, or to break and close below the slanted neckline, which is this dotted line right here. And either way you look at it, we have that violation of the neckline, which validates the head and shoulders pattern. Now, the most aggressive way to get involved in the head and shoulders is to involve yourself right as the breakout occurs. A more conservative way is to wait for a pullback, exactly what we're doing right now, into this right shoulder. It's a really big zone here, but this is the zone we're looking for the pullback to come into, and then looking to catch the next extension down. Very similar to what we did here. We created a bottom. We had a brief moment of retracement. We had a better price right here, and then the bears were able to catch that next move down. Well, they were able to catch the next move down here, but we're looking to do that again over here. So that is going to be the bearish side of things. Pause that because we're going to come back to that. Now, from the bullish side of things, here's what we have. If you are someone that is believing, hey, Netflix is stronger than it has shown, and these high-profile investors that are now getting involved are going to encourage more investors to get involved, and the turnaround could be coming. If we go down to the daily chart, we're going to have the exact same thing as what we had on the weekly chart, just in the opposite direction. We have price bombing down from our 108 level right here, all the way down to our lows here. A little bit of a retracement right there, followed by the briefest of extensions. We have now retraced all the way back to that neckline. And what we would need for a completed head and shoulders pattern is going to be one failed extension downward. And then again, price action to move back up and violate that neckline. If we can get that, and honestly, we don't even need the right shoulder, to be honest. If we can get a violation of this level right here, that would be a good sign for the bulls. Again, a head and shoulders pattern is a classic reversal pattern. If you are someone that is saying, hey, price is cheap enough on Netflix and a turnaround may be happening, this is the exact pattern formation that you would need to have that turnaround. Now, here's where both can combine together, because I don't want you thinking, hey, oh my gosh, I'm thinking bullish, but the bullish conflicts with the bearish. You can actually both be right. So if you are a Netflix buyer and you're projecting this head and shoulders to occur, you're expecting price action to violate this level and eventually work its way back up. In reality, it's probably going to ebb and flow a little bit, put in a little trendy action, but regardless, you're looking for it to work its way back up. If we go back to the weekly, right, for the head and shoulders bearish trader, Remember, you're looking for that pullback. I told you that pullback can come anywhere between here at about 75 bucks up to here at about 109. Well, yeah, that smaller head and shoulders move can be nothing more than the pullback you need in your bigger head and shoulders move down. And I say that just so you don't get freaked out and thinking that it has to be one way or the other way. Both can certainly be true, and that's called fractals, and that's a whole nother inception type of thing that I don't want to dig into this video. But whether you are a Netflix bull or a Netflix bear, I've got something for you here. Just make sure your directional bias is based off your fundamental bias and not just your technical one if you're an investor. Next up, we're going to be on the Australian 200, which is the Australian S&P, and we've got a trend continuation opportunity setting up. Just to zoom out real quick, if you guys remember what I told you last week, a shortcut to identifying trend is ask yourself, is price action moving from the bottom left to the top right? Yes, we are. Don't overcomplicate it. Yes, we are. With that being said, from a more technical perspective, right, tier one traders, you'll appreciate this. We have also just created, right, a week ago, a new structure high. This was our previous high watermark right here. On this green candle, price action broke and closed above it, creating what we call a new structure high, confirming the bullish trend. Now, I know what you're saying already because we do this every day in the live room. Yes, we do have a butterfly pattern here as well. And just real quick, because I love the butterfly pattern, I'll draw it out for you and take you a little bit through the psychology of it. A butterfly pattern is a harmonic pattern formation that completes above the X leg, and that can be very scary to many people, but the psychology behind the butterfly is this. Price action has rallied pretty much all the way from the lows to the highs, and like with any rally, after we've seen a lot of momentum in one direction, we tend to get periods of relief as those buyers look to take profits at the highs, and then more sellers enter as well before the trend eventually continues again. So don't get scared away by this butterfly. It's actually doing what it's supposed to do. We've hit the decompletion. Price action is now retracing back into structure, so giving us a little bit of relief. And as a pullback trader, someone looking for a bullish continuation trade, this is the type of relief that you're looking for in order to get a cheap buying price. Now, the question is, where is this relief likely to come to? And I've got two levels that I am interested in. One is the first level that I think we will probably run into trouble at. And the second level is a no-brainer. If it gets to that level, please buy as quick as you can. So the first level that I would expect price action to come to is going to be this level right here. If we take a look at this green candle with the long wick, this long wick to the upside means at some point the bulls pushed it up, but then at some point the bears pushed it down. So that's a nice little rejection level. It's an area where sellers were interested before, and then the buyers eventually defeated them. It is an area that sellers will be aware of again, and that buyers will be interested again as well. And if we take this level and drag it out to the left, you're going to see that we have some pretty decent confluence at this level as well, in the form of some inside structure, the B leg of that butterfly. So this is certainly a level that I would expect price to go to. This would be my kill zone. Now, we're not going to talk about this level too much, but if price action were to break through, destroy, rip apart, and just completely ignore that kill zone, then the next spot of interest would be right here. And this one should be a little bit self-explanatory for you guys that are familiar with price action, but once again, you can see we have a lot of long wicked candles to the downside. Maybe not this first one so much, but the 1, 2, 3, 4, 5 after that. Once again, those long wicks show us rejection from the opposite party, in this case, the bulls. If price can come down to that level, I would expect the bulls once again to get involved, because typically the way things work in the market is if a party holds off a level at a certain level once, you can certainly expect for them to at least attempt to do it the next time price returns. You can also expect the other party to be a little bit scared next time it gets there, because they remember what happened last time they tried to push through. Failure. So let's dive into the daily. Again, you can see our zone here in that up and down action that I spoke about on the higher time frame actually looks more like an up and down action on this lower time frame, hence why this is the level I'm interested in. We do get some added structure in here as well. Look at the wicks, right? a good level to line up with our inside level of structure. So this is where I would expect price to retrace to. Something else that we spoke about in last week's video that we have here is, I'm going to try to hold it so you guys can guess before I say it, because that's part of watching this video. It's not just getting ideas, but it's learning. So you should try to guess what I'm looking at before I actually show you, right? Was that enough filibustering? Yes, okay. This is going to be called hidden divergence. Again, we have a low here on our price chart, followed by a projected, right? We're doing it right now technically, but a projected higher low here on our price chart. However, on our indicator, the RSI down here, we have a low right there, and then we have a lower low right here. This is called hidden divergence. This is a good sign for a trend continuation trade. So all in all, what we're looking for is two levels here. We're looking for a first strike level in this level. Obviously, we're not just looking for a price to get down into that level, but we're looking for a price to give us a reason for entry at that level. I just had a very good conversation with a trader on the platform who was super aggressive with his entries and losing. And I said, hey, maybe be more conservative. Maybe wait for some proof first. I certainly recommend doing that. And if you can do that, you can catch the extension here and shoot for higher highs here on the S&P. If this level does fail, then keep an eye on this level right here. It looks like this may also, as I get all nerdy on you, I apologize, give us a potential Fibonacci inversion trade as well. Let me just see real quick. A Fibonacci inversion trade is essentially a fake out in the market. So it's when the market kind of puts in a move like this where it looks like it is violating a trend, but this is not really a pullback. So it doesn't really violate a trend, and then price goes like that. What I want to do is I want to take my Fibonacci extension tool from my swing high to my swing low right here. What I'm looking for personally is a 1618 Fibonacci inversion somewhere down in that blue zone, and right at the bottom of it. Yeah, right at the bottom of it. So again, these things aren't perfect, but anyway, if we do violate this level and we end up going down to this level, again, I think this is a no-brainer level for buys as well. I would just advise that you get your stops underneath this level too, in case the market tries anything sneaky. So nice buying opportunity here on the Australian S&P. Now, if you remember from last week, we spoke about the yen pairs. I think I mentioned it on the pound yen, but I said the euro yen looked exactly the same, and many of the other ones as well. But we're looking for a buy at the bottom of this zone, and well, we did exactly what I thought we would do. Now, there is still more meat left on this bone. However, it's not right now. And I say that because you don't want to be the person that is late and hop in just as we get to a zone of rejection. So just like in the previous example we looked at, we can see the long wicked candle right here. This is going to be a zone of rejection. This is a zone that I don't really want to fight through as a bull. Why? Because the last time the bulls tried to fight through this level, they got smacked in the face and they lost. So it just doesn't make much sense for me to do it. Rather, I want to see proof, meaning I want to see a break and a close above that zone. That is going to confirm the bullish breakout. And if we get that, then we can project a move up to our highs right here with this 186.5 or 187 even handle right in the middle there being a nice projection level for us to go to. So if we look one more time frame down on the 4 hour, you can see a clear level of our structure. What I'm waiting for here on the euro yen is a violation of this level. My personal style is a pullback trader, so I like to look for a pullback and then a chance to buy it up from probably around these 185s up to, again, 186, 186.5, or 187. We could do some more analysis on it later in the week, but wanted to put the idea in your head again because this idea from last week still isn't over, but I would be cautious and wait. If you haven't heard it already, wait till you hear this story about how I lost everything in this $215 million scheme, or check out this playlist specifically created for new traders. All right, like, subscribe, all that good stuff before you go. I'll probably see you Wednesday with another video. And until then, plan your trade, trade your plan. Take care.